if you're having a hard time qualifying for a mortgage to buy the home that you want to buy, even though your business is thriving, then this video is for you. So I work with self-employed home buyers that are looking to buy, typically a luxury home or a very nice home for their family, but they may have been turned down by a typical bank or mortgage company because the underwriter said they don't make enough income or show enough income to qualify for a mortgage. Well, this is very, very common. And I like to say, and I say all the time, there's not a lot of common sense in the mortgage industry. So what we're really dealing with is what I would call the illusion of low income. You know your business is thriving, but the way underwriters are required to document income, qualified income for a mortgage is through tax returns. So whether you're getting a jumbo mortgage or a conventional loan or an FHA loan or whatever kind of loan, traditional mortgage, you're going to have 2 years of tax returns, and they're going to take the average of those 2 years. Now, if your business had, let's say, for example, we're in 2025. Let's say in 2023, you had a good year, but in 2024, you had a better year, then they'll take a 2-year average. But if it's the other way around, 2023 had a great year, 2024 wasn't as good, then they're only going to use the 2024 income because you can't have declining income. So why is that? And how do they calculate that? Well, it's called the ability to repay. And so there's a law that says you have to, have the ability to repay. And what they're always looking for is certainty, right? They're looking for income that has a history of being collected and has a certainty to continue. Now, how they qualify that, why they won't use different calculations, I don't know. But unfortunately, that's just the rules that we have to work with. What we do if you don't qualify in that manner, and I will say the first thing I do is I get the returns and I get it through them and see, is there something that somebody else missed, or is there another way to put it together? Many times I find there is. It just takes some creative financing, let's say, moving different things around. But if that doesn't work, then what we would typically do is use bank statements. So there are a couple of different ways to get a self-employed person qualified, but bank statements are the most common way. Before I talk about that, I want to talk about your tax returns and maybe some slight differences and things that I see people commonly misunderstand when it comes to, say, a Schedule C and an S-Corp that are filing tax returns. So a Schedule C is you're only filing one tax return that includes your personal and business returns. But there's a Schedule C that has all your business income. And if you file that way, you can easily pull it out, and I actually have a calculator somewhere on my website where you can plug in the numbers and figure it out. But basically, you look at line 31, that's going to be your net income. And then if you look, I think it's line 13, you can add back depreciation. So let's just say you have 100,000 income, easy math. You had 10,000 in depreciation. Well, you have 110,000 that you can use. You can also add back, say, small things like business use of home. You can also add back business mileage. So let's say that you drove 10,000 miles for business. It's going to be there on Schedule C. I believe it's 26 cents a mile for 2025. You would take 10,000 times 0.26. You could add that back. But really, that's about it. Now, an S-Corp, this is a very common, and I would like to highlight this misconception that I get from people. You cannot use, as the business owner, your W-2 income like an employee of yours would use. So I have a client or potential client. We talked yesterday, gave me a call. He's in a bind. He sold a business in another state. I live in North Carolina. He moves to North Carolina. bought a successful business here, thriving business, but he just became the owner of this business. He's paying himself, I think it was $150,000 salary on a W-2. Doesn't matter, because you have to have 2 years of business ownership. And really, no matter what kind of loan you're doing, you're going to have to typically show that you've been a business owner for 2 years. Fully documented loan, you're going to have to use 2 years of tax returns. Now, this is where we have a good segue into if the tax returns work. Well, back to the bank statement. That is the most common type of loan that we use. And this is basically how we would take your most recent 12 months or 24 months of business bank statements. We would add up all of the deposits, and we would then look at your type of business. So there's going to be an expense ratio. Let's say, for example, you're a consultant, you work from home, you don't have any employees, you have an office, then we'd probably be able to use 70 or 80% of those deposits, and that would be, your annual income. If you say have employees, maybe you have a type of business like you're a home builder, you're gonna have a lot of overhead. Well, then we would use 50% deposits, but we can use at least 50% of deposits to calculate your income. Another way to do that is you can use personal bank statements. So sometimes I see business owners that they get, they're on the cusp of default. They get all their deposits into the business account, right, in the business, but then they're transferring a lot of those or most of those into the personal. Well, if you have a business account and a personal account, then we can use 12 months of your personal bank statements, but use 100%. So that helps you. If, for example, like the gentleman I just talked about, you have a brand new business, you haven't been in business for 2 years. Another way to do these kind of loans is basically called an asset or asset qualified. There's a number of ways to do this, but in general, let's say you have 125% of whatever the mortgage amount you want to borrow, after closing, then you qualify. You don't have to have, don't even really have to have a job, because that is you don't have to have a job history. We can do that. So if you have a lot of assets, we should talk. There are a number of different ways to do that. Now, I would say the loan may be a last resort, and I do, a number of these loans as well, is called a no ratio loan. Now, in that case, you don't have to have any income. As long as you put 20% down, you have a 680 plus credit score, and you have 6 to 12 months of mortgage payments left over in some sort of account after closing, then you qualify. But the downside is the interest rate's going to be close to 9%. So this is typically a shorter term loan. Until you can qualify for another one, then we'd refinance you out to a lower interest rate. Speaking of interest rates, a bank statement loan is going to have a higher interest rate than a traditional loan. Now, if you have enough down payment and your credit score is good enough, it might be about the same. I just did a refinance last month for a gentleman. He had 50 or 60% equity in his house. And actually, I think he had 40% house. Sorry. Good credit score. The interest rate was the same as a typical jumbo loan. So there can be trade-off, but not always. Just depends. One maybe good client example I have is a gentleman I'm working with right now today, needs to do a cash out refinance up to 80% of the value of his home. Now, he does have a Schedule C business, been in business a long time. But from the tax returns, after all the write-offs, there's only about $9,800 a month that we can use. And that's not enough to qualify. But when we took his last 12 months of business bank statements, added up all the deposits, applied the expense factor, he's got basically $70,000 a month he can use to qualify. So basically, no problem to get the cash out refinance. But on top of that, basically almost buy whatever you want as long as you have enough money for a down payment. So, and that's a great example of how we can qualify somebody that doesn't qualify through traditional means. So if you're thinking about buying a home in 2026, this is the time of year. This is being filmed in October of 2025, where you're doing year-end planning. Some things that you can do if you want to try and use tax returns, is look at depreciation. If you have items you can depreciate, then you can list those on your tax return, because that can be added right back into income. Also, if you're a Schedule C, like I mentioned, business miles. If you drove a lot of business miles, you can add back, that as depreciation. So if you found, this video helpful, please reach out to me. If you have a scenario, you want to talk about it, you can go to my website, mortgagesbyscott.com. You can fill in, basically a form where you reach out to me, tell me what's going on. We can schedule a call. If you'd like to just schedule a call, I'll put the link in the description below for my calendar. Just pick a time that's good for you. We'll jump on the phone. And if you want to just apply, go to mortgagesbyscott.com and click on apply. If you found this video helpful, please click like and subscribe. And if you know somebody that you think would find it helpful, it'd be great if you would share it with them. All right. Thanks for watching.